thank everybody for the invitation today and the organizer of the very interesting conference today. I've been really enjoying the discussion so far. I'm going to share my screen in a second. Let me see if I have it there. There we go. You should be able to see my presentation. Let me go in presentation mode. There we go. Okay, so yes. What I'm going, all good, right? Yeah. So what I'm going to talk about today is some practical consideration about like issuing central bank digital currencies. And yeah, as my talk today is based on some work that like is being joined with like Georg from University of Cape Town, and two colleagues here in Algorand, Pietro Grassano and Navid Isaluna. And part of my presentation today is going to borrow some content from a white paper that we recently wrote about like CBDC issuance and like issues and like implementation of CBDC models. A caveat before I start, my second part of the presentation, there is like some new work like that we are thinking about. So it's a work in progress and like is meant to pick your brain a little bit on some issues that like I think that deserve a lot of still some attention in our research. A caveat before starting, there is everything I'm referring to today is like a CBDC models that like assume that there is like a DLT system underlying the architecture of the CBDC. There should be a question at the beginning, which is like, what about why DLT is good for CBDC? And this is a very important topic that deserves like an entire discussion on its own. I'm not going to mention much about this. There are like clear infrastructure, or what we believe is clear infrastructural advantages. The white paper I was mentioning that you can find on the Algorand website, for example, like deal with these advantages. But again, I'm going to jump straight into some more interesting detail about like architectures. And this is like the motivation and a little bit the introduction for my talk today. So what we know is that, and like the talk that like the Professor Duffy just talked about, finished a minute ago, it made this point very clear. What we know is that there are like several CBDC models that have been proposed and they're out there. And there is no such thing as a one-size-fits-all CBDC model. And typically, when we want to talk about what model is good for a country, we need to keep in mind the goals of the central bank for this country, the characteristics of the economic system, and the financial system for this country. However, there's been some sort of convergence or progressive development of one type of model that like seems to be more preferable for many applications and many proof of concepts. And this is the so-called hybrid intermediate model. So what I want to do in the talk is to overview a little bit the differences between this model very briefly. And then I'm going to jump into the differences between intermediate and hybrid models specifically, and hybrid models specifically. I'm going to use this difference to touch on a few issues that, like from a practical perspective, when we implement a CBDC, still require some understanding, some research, some further analysis of the implication from a policy perspective and from the governance perspective of the CBDC model. Okay, so I spent like 5 minutes talking about like a possible architecture for a CBDC. This is like an elaboration from the annual economic report 2021 issued by BIS a few weeks ago. In a very simple nutshell, we have 3 or 4 mainstream models for CBDC. First of all, we have a split between single tier and 2-tier models. The single tier is what go into what we call like a direct model. And for example, talking about China, it was not clear if it's direct or hybrid. It's more like hybrid, but has many aspects that like look very similar to a direct model to many extents. However, going into the two-tier classification, we have like an indirect model, also known as synthetic model, which for some people are not even like a real CBDC models. And then we have what we call like a hybrid intermediating model. Here, there is an interesting pattern that we have been observing. Until like maybe a couple of years ago, we were only talking about hybrid model. Now, more recently, this intermediate version of the hybrid model is gaining traction, some popularity. So that's why I want to focus on these two models specifically later in the second part of the presentation, and see a little bit what different implementation, or if different implications these two models have under like a couple of key aspects. So I'm using this table here. No, I don't want to go through line by line, obviously, but I'm just using this table to give you an idea, a simple idea of what the main difference in the main characteristic of these four models are. And it also gives me a very easy way to tell you why hybrid and intermediate model are usually preferred once we go to the implementation of the systems. The big problem with direct synthetic models is that for the synthetic models, basically we don't even have a CBDC, which is a legal claim on the central bank balance sheet. And so that's why I'm saying for many people, for many central banks in particular, this is like a no starting point even. And then also they have issue about the size of the balance sheets of the service providers that interact with the central bank, which are very large because we are talking about banks, typically banks, they need to have a one-to-one matching between wholesale and retail balances for CBDC balances. On the other side, for the direct model, the big problem is that it requires a very high degree of involvement of the central bank into the operational aspect, management of wallets and these kind of things for the day-to-day operation of the CBDC system. This is not the core job of the central bank, and that's why is often considered a suboptimal type of architecture. So when we look at the hybrid versus intermediate model, or specifically these two models compared to the direct and synthetic model, what we see is that or what we can think of this model as is something between the two models, the direct and the synthetic, or the direct and the indirect model. In the sense that they try to mitigate some of the aspects of some of the drawbacks of the synthetic, of the indirect model. At the same time, they try to keep an involvement of intermediaries. It can be service provider, payment service provider, it can be banks, commercial banks. So mitigating these drawbacks, by keeping involved the bank sector and banks in the activity of the CBDC system. And probably the biggest advantage that we can think of is a mitigation of the negative disintermediation effect that CBDC could have. So I will start my talk maybe looking a little more at the disintermediation and the implication of this intermediated and hybrid model for disintermediation. And then I will jump to a few practical issues that still, as I was saying, require a little bit of research attention and understanding from our side once we have to issue, once we have to implement these models. In terms of what we see out there in the landscape of different central banks trying to apply or to develop CBDC model, which central banks, which countries are going with an intermediate or hybrid system? Well, basically all the banks, all the countries that have already some sort of implemented the deployed model, like Bahamas, for example. But also most of the banks that are looking at retail CBDCs, that have use of proof of concepts or experimentation, like Sweden, for example, is looking at the hybrid model. So there is this consensus, it seems, among banks and central banks that try to develop like system that like to consider this type of model like the most suitable, the most interesting or efficient, effective, sorry, for the CBDC deployment. Okay, I pause here for a second in case there are any questions so far. I know I've been very quick, very fast through the models. Like, if there are questions, I'm very happy to go back to some of these characteristic features and talk more about those. Okay, I don't see any. And also in the chat, Jim can tell me if something pops up. Okay, thank you. So talking about this intermediation, I'm going to use like a couple of balance sheets, okay, very simplified version of aggregate balances for balance sheets for like the economy, just to give you an idea of what like the problem is. Here we have like a typical situation where we have a non-bank sector, so consumers or firms that like hold deposits and cash issued by the central bank, deposit issued by the bank sector. And deposits are used to issue loans. They are like held, for example, by firms, or mortgages by consumers. And cash is issued against like liabilities like bonds from the non-bank sector. So when we talk about this intermediation, the problem is this. If deposits are used to purchase CBDCs, we are going to have a shift of activities, so assets here represented by loans in this in the bank sector, so a shift of the assets from the bank sector to the central bank. And this is not considered like a good feature by any of the goals of like a central bank when they think about CBDC, for obvious reason, because like it can create problems in the credit provision, in the transformation of maturities activity, and so on and so forth. So this is like a very well-known problem with CBDCs. What are the solutions that are being floating around for this type of problem? There is like a very, very well-known solution proposed by Brunner-Meyer and Nippel in 2019, which sounds more or less like this representation, where like the central bank can try to supplement like bank sector funds by issuing like borrowings debt to the bank sector, which in this case doesn't have to substitute loans for, it doesn't lose like loans on the balance sheet, because like they can use the borrowings from the central bank to replace some of the deposit they lost for the issuance of the CBDC. Under some conditions, in particular, like about the distributive effect of borrowings or like funds released by the central bank, this type of solution theoretically, technically can guarantee the same type of allocations in terms of loan structure, like investment structure of the bank sector. So this is a very well-known paper that like is requires like some further comment in terms of like from the perspective of the implementation side. Basically, the idea here is that like in order to implement a solution as the one proposed by Brunner-Meyer and Nippel, you need some sort of involvement of the bank sector into the CBDCs. You need like an alignment of incentives between the central bank and the bank system, the bank's operators. They operate like a service provider in the central bank. Basically, in some sense, if you attended this morning, like Christian Catalini presentation, he was talking about a very similar point. You need like a partnership. A successful CBDC requires a partnership between public and private sector, central bank and intermediaries. And the hybrid system and this intermediate system basically propose or provide a way to get the central bank, the bank sector very closely involved in the CBDC system and very closely aligned with like the interest of the central bank. The second reason why I see that like it matters for like the introduction of intermediaries in these models is that there is a bunch of activities like delegating onboarding, like management of wallets, these kind of things that like can be delegated to the intermediaries by the central bank, which generate new streams of profits and like also can generate new models of credit provision. So I'm going to say a little more about this in a second. However, before going there, like there are many solutions here or many policy considerations about this intermediation that we have been seeing like in the literature. We know that like bank runs might become a problem once we have a CBDC. There is this very nice paper by Mancini, Grifoli, and others, 2018, that like makes this point. There is also a paper by Fernando Villaverde and Linda, by the way, is one called 2020, that like show that like maybe not so much of a higher risk, but like there is like a risk of very strong disintermediation. However, like there are other solutions proposed for to avoid disintermediation. There are like papers like Bordo and Levine 2019, Vincel 2020, who look at possible different interest-bearing or interest remunerations policies for CBDC holdings. And there are like different characteristics, different things that like matter or like are interesting in this paper. Like we propose and we discuss a solution in our paper that like exploits or like goes along the same lines. And here is like how it works. We think of this as like a subsidized type of deposit policy, in which we start from the situation where like loans went down because of some disintermediation effects due to the central bank issuing CBDC. And but what we propose is this type of solution, like or what we think a solution could be to disintermediation is this mechanism. If you allow banks or intermediaries to collect deposits, to take deposits from the non-bank side, the central bank can subsidize these deposits by basically closing the gap between the borrowing interest rate and the lending interest rate of the bank on the other side. Why is that? Because like once you have a service providers in the CBDC system that like provide payment services to the public, the banks lose this advantage like of usually linked to the creation of deposits. And so like they will be required to increase their interest payment, the interest return on deposits, on CBDC deposits. What's the advantage here to have a DLT system for the CBDC, the like or programmable money for this type of solution? This type of solution requires a very careful micro level management of like these payments and like knowledge of transaction, knowledge of balances that like can be actually implemented thanks to a CBDC on a DLT system. Okay, I think this is good for the first half or two-thirds of the presentation. I want to go to the last section. Again, if there are any questions, please interrupt me anytime, or if there are also questions on the chat, Jim can look at it. Okay, Dara has a question, please.
I don't mean to interrupt.
Absolutely.
Well, the idea that when the banks can't raise funding with deposits because the people are holding money in the form of CBDC rather than deposits, my thinking on this is that the banks will have to raise funding in wholesale markets rather than deposits, and they'll pay more for their funding because they have to pay a market interest rate rather than a low deposit interest rate, and therefore the banks will be less profitable. But I don't see why they would make fewer loans. If I was a bank lending officer, I would only make a loan that's profitable. I would not make a losing loan with the idea, oh, I can make up the losses because I'm getting cheap deposits below market. So I'm not entirely convinced about this story that you need to help the banks get through this problem. I think they'll be less profitable, but credit provision will not necessarily be impaired.
Sure, like the part of the discussion there is like how to preserve profitability of banks. Absolutely. And if that's a goal of the central bank, or if that's the goal that like is considered necessary to switch into like a CBDC model, to convince like to overcome some frictions in the transition process.
Political frictions where the banks say, don't do it, right, because it'll be less profitable.
Yeah, because, and so, they lobby and they convince everybody that like, there's
okay, I get that part, but I don't think I don't think it's a good idea to form policy around preventing disruption.
One question I have for you is that like your assumption that you make here is that like the current allocation is not efficient though, or not. If that's the case, sure.
Okay, that was just a comment. Thanks very much.
No, absolutely. Like for example, in the paper by Bruno Maya was mentioning, like they start from probably the opposite view, where like they say like the current structure is the optimal, socially speaking, optimal one. Like how do we replicate that after the introduction of CBDC? Thank you for the point there. Okay, so in this last part, 15 minutes or so of the presentation, as I said, I'm going to look into the hybrid versus intermediate model a little more carefully, and use the difference between the two models to pick your brain with a few issues that like still are important, still like I don't see a clear answer for, and like I believe they still require like a lot of research. In particular, from the practical perspective, once we want to implement these models in the real life. Fundamentally, the difference between fundamentally hybrid intermediate models are very similar. Okay, they're like 90% the same. The big difference, however, is in how much of the retail transactions the central bank observes and knows. Where in the hybrid model, like typically we think of that as like a model where there is like a full or almost full visibility, so very little anonymity by design. While in the intermediate model, as is being like, for example, proposed by Hauer and Baum 2020 and the BIS report 2021, is something where like the central bank sees only the aggregate balances of the intermediaries, but not the transaction at like a retail level. In terms of like a DLT underlying structure, my interpretation is this, that like there is some sort of DLT infrastructure that like is shared by the intermediaries, let's say for simplicity banks, and they plug into this infrastructure through APIs, for example, and this infrastructure is separate from the bank that has access only occasionally to the history of transaction and the blockchain. On the other hand, for the hybrid model, we have like a more open type of blockchain or DLT infrastructure where like everything is visible to the participants. As I was saying, like there is an important role of intermediaries in this model, and intermediaries are going to be required to, not required, but they can be asked to take on activities like onboarding of consumers, KYC, keys management, custodial services. Actually, the custodial service is one of the key points in the difference between the two models, where like the intermediate system seems to push a lot on the fact that like intermediaries have to be custodial, have to provide custodial services of wallets. While for the hybrid model, this seems to be a less of a requirement. Actually, it's not even a requirement in that respect. We can skip here and go to the next point. Okay, so this said, I have like 3 or 4 like points, 3 or 4 issues that I want to raise. That like as I was saying a minute ago, still don't have a clear answer, or still like require like more research and understanding. The first point is about visibility of the transactions and the selection of validators and node runners. Okay, these 2 slides. Let me start from visibility in terms of anonymity of transaction. This is considered one of the primary goals of a CBDC system in many jurisdictions. For example, for the ECB in Europe, it's considered #1 item by the government as well, #1 item priority for the transition to CBDC. And this is probably one of the reasons why the European Central Bank and the Bank of France, as like it was mentioned earlier, are pushing for a wholesale rather than a retail CBDC system, most likely. An intermediate model might be able to provide like a very good level of anonymity by separating the source of information, the source of identity information from the source and the bookkeeping, the recording of the transaction activities. The intermediate model assumes that like the central bank is going to receive information only about, in aggregate form, about the, let's say, the wholesale leg of the transaction. So those that like are referred to intermediaries as a whole, instead of like retail transactions. In this sense, the hybrid model is a little weaker in the sense that, like in principle, the central bank has a full visibility of the transaction histories. There are obviously techniques like obfuscation techniques that can be put in place to preserve some degree of anonymity. There are like key mixing techniques, or like VPN shields, these kind of things that like have been studied and discussed, but like it's not clear how far on how good this obfuscation is going to work. In particular, if we connect this point to the selection of validators and node runners of your DLT system. Typically, what we see is that like the CBDC system is implemented or should be implemented on a permission instance of a blockchain. And which means that like the owner, or like the entity that has the ownership of the DLT system has to select validators and node runners. But the 2 big questions that come here are like, what criteria do we follow to select these validators and these node runners? More specifically, a validator should in principle have like full visibility of the transaction. So is a question like, should the central bank be a validator at all, which seems like obvious to many at first sight. You say, yes, they should. Probably they should not. And that's like part of the problem maybe with the Bank of China design, if Dario agrees, like in terms of anonymity, we were talking about before, anonymity. There is no probably a way to guarantee that kind of goal. At the same way, node runners, like they broadcast the information through the network, the full information. So they have kind of full visibility. So the question is the same. Who are these node? How do we select these node runners? Should like a government, should the central bank have a node? Probably no. Should an AML agency have a node? To what extent? But even more crucially, when we talk about intermediated and hybrid system, is like whether or not we require intermediaries to run a node, or whether or not we even want intermediaries to run a node. In many implementation models that we've seen around, like the answer is yes. People say like, sure, they should, some of them should be, some big banks should participate. We talk about like one of the proposal with Andreas for the Luni, digital Luni in Canada, where like they discussed.
Yeah, Andrea, can I mean, I was
sure,
about to ask a question, put in the chat.
Yeah.
I mean, it seems to me that there's a strong tension, right, between the goal of anonymity and the goal of stopping cash transaction, let's say, connected to criminal activities, and much of what's desirable in KIY, right? And it seems like, you know, I mean, we can talk about the technical difficulties of technical solutions of achieving one versus the other, but it seems like there's an unresolvable tension here. So how do you think about this? I mean, how, you know, right now I can give somebody, you know, $50 in cash, right? And the government, there's nobody seeing that except the two people involved. But the moment it's done via an account, by some validator or whatever, you know, it's observable, right? And maybe that's desirable. If you're saying all of that should be anonymized, well, then you can have criminal activity with anonymous transactions that cannot be done electronically. I can't see that that would be a desirable goal. So how do we resolve the tension? Not just technically, but you know, where do we draw the line?
No, absolutely. So like there are two aspects here. Like on one side, we have the legal aspects, let's say, like we have AML functions that have been conducted. And so there might be rules, obviously, that say for this reason and this reason, anonymity is dropped. And that seems to be something that upon which everybody agrees, right? The other side that like I had in mind more when thinking about this is like if we allow like a bank to have full visibility, they might like you know, sneak peek on activities from other competitors, and in that case like it's something that like it doesn't provide a level field, right, for the service provider, for like the node runner versus the node runners providers or intermediaries in the system. Then resolving the tension is that like there is a funny thing there, like thinking of about the intermediate model. Many people will say we prefer to have a bank or like an intermediary that like is kind of a gatekeeper of my privacy information, and so like we prefer like to have a private company guaranteeing that like nobody's going to see our transaction, or we're going to be sufficiently anonymous. While there is like a mistrust for the government doing the same, or the central bank doing the same, or the IRS not trying to look into the transaction once they are on the CBDC system.
Yeah, these things were used to be called Swiss numbered accounts, right? I mean, now we know the history of that, right? I mean, we used to have them, and people like them, and I guess, you know, governments have fought against them tooth and nail. So I can't possibly see how anything like that will survive the introduction of the CBDC.
Yeah, I agree. Part of the reason why I'm raising this question is exactly this. That like I didn't see like a good solution around yet, or a solution for this yet. Moving on, like there is a general. Any other question? No. Okay. There is a general consensus that like the governance of the CBDC system should be centralized. Fully centrally controlled by the central bank, but like to what extent, or to which degree of decentralization is desirable for the processing and the running of the transaction, this is not clear yet. In the sense that, like as we were saying, like it can be a requirement for all the service providers, intermediaries, to be also a node runner. Maybe this is desirable. We want to have a very broad number, a very broad type of a set of node runners, but maybe we would prefer to have some sort of opt-in possibility where like small providers don't want to be node runners, and like larger providers instead want to provide these services. There is a big discussion about fees here, and how you create there are incentives to convince these intermediaries to operate and to work hard for the rest of the blockchain. We touched on this like this morning as well, with a couple of questions, I think, to Andrea's presentation. So second issue, I have a few more minutes. I'll try to be super efficient, Jing, sorry about that. Second issue is like the size of the CBDC balances And why is this important? Because like it determines in practical terms in the type of intermediaries that we can have on our CBD system. Fundamental distinctions that like in intermediate system, the intermediaries need to have like big guns, in the sense they need to be able to have like a large holdings of CBDC, because they have to reflect one-to-one the customers like holdings. Why? Because there is this issue of like the custody of wallets that like retained by the intermediaries themselves. In the hybrid system, in this sense, is a little more flexible in the sense that like it can accommodate small and big service provider. Like it can accommodate like banks that like want to are able to provide this kind of service. They might want they can also this system, the hybrid system can also accommodate very small providers and very small intermediaries. They like they just want to provide some sort of payment service. They don't want to do credit deposit taking at all, and like possibly we think this kind of intermediaries are also useful, important for innovation, for growing of the ecosystem, all these kind of things. So like going in one direction or the other might have like important effects on the type of infrastructure, the type of architecture that we design. What's the risk here? That like if you require like custody, require like a strong connection to the RTGS system of a country to be able to process the wholesale legs of the transmission, of the distribution of the CBDC, we are basically converging back towards like a more traditional type of banking system, where all the problems and all the things that like we want to overcome with CBDC might not be so easy to solve again. Last point I want to make is about like interoperability with other payments. Payment rails, payment systems. The big question here is this, like, do we want to have a CBDC that is like a closed loop payment system or an open loop payment system? A closed loop is a payment system where like the transaction starts and ends within the same system. So there is very little possibility of like integration and interoperability. Open loop obviously is something that doesn't necessarily stop within the payment system, the payment rail itself. My belief here is that like a hybrid and intermediate system can both accommodate some sort of open loop payment system. Okay, but like between the two, I see that like the hybrid system is a better position to act as an open loop instrument. So it's a very powerful kind of idea in some sense, because like it means that like the hybrid system seems to be flexible enough to become an open loop payment instrument itself. So this is a very important question when we look at, for example, integration with pre-existing payment system, payment rails, or when we look at these issues in countries like Europe or Brazil, where they have like a fast payment platform that are already developed and working pretty well. An idea that's floating out there that seems very interesting, that like the CBDC can become, if it's an open loop instrument and flexible enough, can become like a digital settlement instrument across different platform, different payment rails. And if this is possible, if this is true, this becomes some sort of basically a game changer for the adoption of CBDC, because it overcomes many of the doubts, many of the critiques that like some countries, some central banks are putting forward now about the fact that like they can do what the CBDC does more efficiently, and they'll be already doing it for a while. And so there is no need to go back to or to change things with the CBDC. Okay, before last question, conclusion, like I hope the main point is clear, that like there are these and other like practical issues that like are important, and even though our understanding of CBDC has rapidly increased, improved over the last years, there are many things that like still require like practical solutions interesting, important key points. The second thing I want to say is that like the knowledge that we have about the policy implications of the CBDCs are still very, very small. Basically, there is not much going on. We've been lucky. We saw this morning one of the few papers that actually is able to talk about something about like using a CBDC or a model related to CBDC. But there are the field is expanding, but we have like really like a lot of work to still do in that respect. Okay, and I'm concluding here. If there are any questions, very good. Or I'll leave the floor to Jim.
Thanks, Shivo. I don't see question from the audience. Actually, I have a quick question about anonymity. I don't think there is a agreed upon definition about exactly what it should mean or to what extent it should be kept. If we want to achieve provable anonymity with zero knowledge proofs, or we could allow heuristic-based stuff like using some maybe IP shielding, other techniques that you mentioned earlier.
Mm-hmm.
Do you have ideas how the discussion is going?
So the discussion I've seen so far is mostly about like this is a technique for reintroducing like some entropy in the system to avoid or to make it more difficult the reconstruction of of the network exposed through machine learning analysis of the CBDC system of the blockchain, right? You guys from the computer science side, you can tell me that whether or not these are like strong enough. My impression is that like nobody believes that these are like a foolproof type of approaches. I might be wrong there, but like without some sort of additional legal framework that legally prevent the central bank to do what it wants, or like other the government do what it wants, there is always a way to get around, or to break these. I heard about like zero proof of knowledge applications for this to this topic, but I really I'm not an expert about that, of course, but like I didn't really see anything concrete coming out for this. Maybe Silvio knows more about that.
Thanks. Well, Silvio, you want to add on this? Well,
yes,
you're
because
about
that
to
was a
talk.
very, all right, yeah, okay. So that was a little bit at the heart of a chat that Daryl and I had before his talk. And in a nutshell was the question of Harold that came through the chat. So essentially, I really believe that right now we can reconcile opposite cryptographically, but we must first know exactly what the requirements are. So there's going to be needing some discussion and education on both sides of the regulators, the technologists. And once you get more informed of what the other side can do and wants, I have no doubt that we can bridge these seemingly clashing views. But we need to have an educated discussion. So we need to learn on both sides what the objectives are, what the definitions are, and clarify to ourselves what we want to have. I see that Daryl wants to add something.
Yeah, I want to add one crucial element to that discussion, which is how important to the design is it to meet the objectives that Harold raised, that there exists a national ID system. Is that critical or not? That is, to get interoperability, privacy, and compliance, do you need a system of IDs that every payment service provider can use to check the legality of payments and the KYC of the payees? It's not necessary?
No. Actually, anonymity can be very easily reconciled without. So, for instance, if you want to some smart contracts properly done, can make sure that the security can only go between people who can receive it and transfer it. And what it becomes a little more tricky is that when you add to anonymity also the requirement that under some circumstances, like a court order, say, then you can unveil the identity behind a certain public key. And so also that could be handled, but it gets a bit more complicated, and therefore it needs a little bit, to be framed exactly what is the level of it we want. But I'm optimistic about finding a solutions once we really frame the problem and we correctly.
Okay, so let me just make sure I understand, because it's critical. Suppose my bank gets an order from Harold to send money to Linda, and my bank has no idea whether Linda is a legitimate person for receiving a lot of money. Maybe she's a terrorist, God forbid, Linda.
Yes.
So somebody needs to be on the other end. Harold can check that I am a legitimate person. Linda has a payment service provider. Do the two payment service providers involved, are they able to ensure that this payment is legal without each of them knowing who the other person on the other side is?
The answer is yes, but it presupposes some context. So the idea is that assume that there is some original, I'm going to go forget terrorism, this is too gruesome. So let's think about it, I'm not an accredited investor and I want to get a security, okay?
Okay.
And so presumably there is a contest in which, to somebody, I disclose I'm an accredited investor, here who I am, and then you can see that this public key corresponds to me. Okay, now I'm identified at least to the person who certifies me that this public key is mine. So my public key hides me from others, but does not hide him from the inspector on my initial identity. Then the magic of cryptography takes over. Once you go for this contest, then you start saying, there is a public key, you don't disclose which one, that belongs to an accredited investor, you don't disclose which one, that transfer this security to you, say, and then you can actually inspect that this statement that I just said is indeed true, and you have no idea who the investor is, you have no idea what the public key is. Even if you are the issuer of my public key, original public key, you no longer know who I am. So we can somehow wrap all this context into a mathematical statement that then you prove in zero knowledge. I'm saying, this does not come without computational friction somewhere, so you must be very careful how you orchestrate all this so that you don't trade financial friction for computational friction because nobody wants it. But in some solution like this gives us at least like the hope that this is a solvable problem.
Okay, what if Harold is a valid certified payer and Linda is a valid and certified receiver, but the authorities want to prevent payer-receiver pairs like Harold and Linda from affecting transfers? Sorry, I'm testing how far your design will go.
Well, you could do that too. So here is the trick. So let me try to the idea is that you want to transform something into a mathematical statement. Then the proof can be done in zero knowledge. So how can this mathematical statement can be made? So what you want to do is say the government publishes. Unfortunately, the government has, if you want to play the game in which they want to prevent me to have access to my money, has to step up and do something. So, and for instance, you may publish, say, a blacklist of terrorist key or people who identify that are bad actors. So then the statement that I would have to prove becomes a little bit more complicated. And it is, there is a key, I don't tell you whose key, And this key further does not belong to this list as lately published by the government, and et cetera, what I said before, right? So you include that you're not part, say, that would be just an implementation, is the first one that comes to mind, then there might be. But the moment in which you create a contest that allows to state a mathematical statement about what's happening, then this statement, you can prove it true without giving any explanation to anybody.
Wow. Okay. That's what I wanted to know. Thank you. That's amazing.
You're welcome. Thanks.